let us review a stock portfolio. As you can see, this portfolio is fairly diversified across various sectors: banking, IT, FMCG, pharmaceuticals, and automobiles. It has good exposure to key companies like Tata Motors, Wipro, and ITC. Now, while having a diversified portfolio is great, there are some important factors to consider. First, the number of stocks in this portfolio is quite high given its overall size. When you have too many stocks, managing them becomes cumbersome, and it dilutes the overall impact that high-performing stocks can have on your returns. It's like trying to carry water with a sieve. Some of the best-performing stocks may not contribute significantly to your portfolio's growth due to over-diversification. Second, not all companies in this portfolio have strong fundamentals. For instance, Tata Steel has shown a negative profit growth rate of -6% over the last 5 years. This type of company may drag down overall portfolio returns. It's essential to reassess holdings like these, especially when better alternatives are available. Now, let's move on to the revised portfolio. This portfolio is leaner, with fewer stocks, but each company here is a solid performer with strong growth potential. We have chosen high-quality companies like Cholamandalam, KPIT Tech, and Polycab, which have exhibited consistent profit growth over the last 5 years. What makes this revised portfolio stand out? 1. Less number of stocks. By narrowing down the number of stocks, we focus on high-conviction plays. This allows for better returns because each company has a higher weight in the portfolio, ensuring their growth potential has a more significant impact. 2. High-quality companies. The selected companies have shown strong fundamentals. KPIT Tech, for instance, has a profit CAGR of 49%, which is much higher than many companies in the previous portfolio. Strong fundamentals improve predictability of returns and reduce the risks of sharp declines. Polycab India is a leading manufacturer of cables and wires, with a market cap of over 1 lakh rupees crore, establishing it as one of the big players in the industrial segment. Its extensive product line includes wires, cables, and electrical appliances, ranging from fans to solar inverters. Polycab's stock currently trades at 6,891 rupees, with a PE ratio of 57.8, which is lower compared to other industrial segment leaders, making it a more attractive buy for value-seeking investors. With a strong ROCE of 31.3% and steady EPS growth, Polycab remains a strong contender for long-term portfolios. Polycab's current PE ratio of 57.8 is higher than its historical median PE of 38.6, indicating that the stock is trading at a premium. However, this is justified given its strong growth prospects and the fact that its PE is still lower compared to other market players like Havells. Polycab has shown remarkable consistency in both sales and profit growth over the past decade. Over the last 5 years, the company has achieved a compounded sales growth of 18%, while its profit growth has been even more impressive at 28%. Looking at the 10-year horizon, sales have grown at a steady 16% and profits at a solid 34% compounded annual growth rate. This consistency highlights Polycab's strong business fundamentals, operational efficiency, and its ability to scale effectively in a competitive market. Such growth trends make it a reliable option for long-term investors. From a technical standpoint, Polycab is currently trading near its support along a well-established upward trendline, which has held strong over the past several months. The stock has bounced off this trendline multiple times, showing that it could serve as a reliable support level for future price action. For investors looking to accumulate, this trendline offers a good entry point if the stock pulls back towards it. Waiting for a retest of this level can help optimize your buying strategy, providing a potential upside while minimizing downside risks. Cholamandalam Investment and Finance Company, or Cholafin, is one of India's leading non-banking finance companies with a market cap of 1.22 lakh rupees crore, making it a major player in the financial services sector. The company specializes in vehicle finance, home loans, and loan against property. With a current stock price of 1,453 rupees and a PE ratio of 33.4, it shows stable profitability, further supported by a return on equity of 20.2%. Cholafin's diversified lending portfolio, along with its strong market presence, positions it as a reliable option for long-term investors in the financial space. Cholamandalam's current PE ratio of 33.4 is higher than its historical median of 28, indicating the stock is trading at a premium. While this may suggest strong investor confidence, potential buyers should assess if the company's future earnings growth justifies the current valuation before making investment decisions. Cholamandalam has demonstrated strong consistency in both sales and profit growth over the past decade. Over the last 5 years, the company has achieved a compounded sales growth of 22% and a profit growth of 37%. Looking further back, over the last 10 years, sales have grown at a steady 19%, while profits have increased at an impressive 32% compounded annual growth rate. This consistent performance highlights the company's ability to scale efficiently while maintaining profitability. With a strong track record, Cholamandalam remains well-positioned for future growth, making it an attractive option for long-term investors. Cholamandalam's stock is currently following a well-defined upward channel, as seen on the chart. The stock has consistently respected the channel's boundaries, bouncing off the lower trendline multiple times. This lower trendline acts as a strong support level. Investors looking to accumulate could consider buying near this lower boundary, where the stock is likely to find support again. This strategy helps in optimizing entry points and capitalizing on potential upside while minimizing risks. Keep an eye on the volume for confirmation when the stock reaches this support line to ensure a strong buy signal. KPIT Technologies is a global technology company specializing in mobility solutions for the automotive industry, including AI, embedded software, and digital solutions. With a market cap of 49,339 crore rupees, KPIT is relatively smaller compared to other IT giants, but what sets it apart is its niche focus on next-generation mobility technologies like autonomous and connected vehicles. This specialization gives KPIT a unique edge in the industry, positioning it well for future growth as the automotive sector embraces more technology-driven solutions. With development centers around the world, KPIT is at the forefront of innovation in this specialized IT segment. KPIT's current PE ratio of 74.5 is significantly higher than its historical median of 56.9, reflecting the market's expectations for high growth. This elevated PE is justified by KPIT's rapid expansion, but the company must continue delivering strong growth to maintain investor confidence and justify this premium valuation. KPIT Technologies has shown impressive consistency in both sales and profit growth over the last few years. Over the past 5 years, sales have grown at a remarkable 50%, while profits have surged with a compounded growth rate of 49%. The company has also maintained a strong performance in the shorter term, with 3-year compounded sales growth of 34% and profit growth of 61%. This consistent performance highlights KPIT's ability to scale and adapt within the rapidly evolving tech industry, positioning the company as a solid performer for long-term growth and stability. KPIT Technologies stock has been following a strong upward trend line over the past couple of years, demonstrating solid momentum. Currently, the stock is trading well above this trend line, indicating that it is not near its immediate support level. Investors looking to enter may want to wait for a potential pullback closer to the trend line, where the stock historically finds support before moving higher. This can provide a better risk-reward entry point. However, the overall trend remains bullish, so the stock may continue its upward trajectory even without a significant pullback to support. Now, let's take a look at the comparison between the current portfolio and the revised portfolio. Over a 15-year period, the CAGR expectation for the current portfolio is around 15%. In contrast, the revised portfolio, which contains fewer but higher quality stocks, has an expected CAGR of 25%. As you can see, with a higher CAGR, the revised portfolio grows exponentially, resulting in a final value of approximately 1.5 million compared to 432K for the current portfolio. That's a difference of over 1 million. This shows how optimizing your portfolio by focusing on quality and potential can make a huge difference over the long term.